Hello, everyone, and welcome to the Banking on Innovation podcast. We have a real treat today, as our guest is Jim Marous. Jim is one of the most prominent influencers in fintech and banking. He's a co-publisher of The Financial Brand, publisher of the Digital Banking Report. He's a host of a top 10 banking podcast, which I can safely say that Banking on Innovation is not in the top 10. And he's a top 5 fintech influencer to follow as well. Jim, welcome to the podcast.
Hey, it's great to be on the show, Jody. And we've talked about these podcasts, I think, for 2 years and how I've been doing them and how you're doing them and the experiences we have. And it's a fun process to be interviewed and to do the interviewing.
So let's get into it, Jim. I think as we look back at this time frame in the future, we'll say this is one of the most pivotal transition times for the industry. What do you think are the biggest market trends that are impacting banks and bankers today? And how does it impact the way that they should be competing?
I like to say when I'm speaking wherever I am that change has never happened this fast and it'll never happen this slowly again. And that impacts everything because I remember a time, and it wasn't too long ago, where we kind of dictated as financial institutions what the consumer is going to see, what they were going to hear, what products they'd be provided. But that's no longer the case. More than ever, the consumer's actually driving the train right now. Everything's happening, but it's happening because the consumers are continually expecting more.
I've shared before that that in the past, the banks had a bit of a moat, a competitive moat around them because they were, whether it's a geographic focus or set of relationships that they had. Clearly, some of that is going away with the move towards digital, and so we're likely to see greater separation between leaders and laggards in the business. What do you think, Jim, will separate the leaders from the laggards in the banking industry?
The best leaders in the banking business are not defined by size alone. A lot of times we see some of the smallest financial institutions doing some of the best things in the industry. And that's because third-party solution providers give them the arsenal that they need to deliver services better than ever before. On top of that, what we've seen is it's not the amount of money you invest in technology. It's how the technology is deployed. I can give you all the best tools in the world, but if you're not deploying them correctly, if you're not deploying them at speed and scale, you're going to fall behind even though you have the tools to do better. It's like having a turbo engine in a car that you're only going to go 30 miles per hour in. The reality is, if you're not using what the capability is that you're being provided, it doesn't make a difference. In addition, leaders and laggards differ because laggards tend to buy great solutions, but then get in the way. How many times have we seen an organization buy great capabilities, but then handcuff the providers of that technology by not letting it actually shine? I take new account opening as a great example. Too many times, organizations buy digital new account opening experiences, and then when the provider comes in the office, they go, I like everything you do, but I still want to start with the driver's license and the key punching. Guess what? You've moved it from a 3 to 5 minute process to a 7 to 10 minute process automatically. And by the way, you bought that technology to bring the services to the consumer that would make it faster and more efficient. Most importantly, the leaders are being defined by the leadership at those organizations. I tell a lot of providers, such as your company, you can find out immediately if your product, your solution is going to succeed or fail within that organization by talking to the leaders and see if they really get it or if they just bought it. If they don't get it, you won't see it be deployed in the most optimal way for the end consumer. If they simply bought it, a lot of times the leader is seeing banking as it's always been done because it's always been successful for that organization. You've got to embrace that change. You've got to take risks, which is like completely counter to what you were hired to do maybe 20, 30 years ago as a leader. And you've got to realize that continued success will depend on listening to the customer and deploying in a way that they want.
So let's talk about the situation that banks and CIOs in particular find themselves in today. A CIO may have 7% of their revenues focused on technology investing, and that's growing, but there's a lot of pressures. There's greater competition, not just from new players, but also from, let's say, large national players that may be intruding onto regional bank territory. There's embedded banking, which is becoming more prominent. Customers are finding it easier to switch, and also there's greater transparency around pricing as well. So if you put yourself in the shoes of a CIO, where should I be investing more, and where should I be de-emphasizing to be able to create more investment dollars to invest in my priorities?
What I like to tell financial institutions that I work with is start from within. You can't deploy all the modern solutions and be resilient to be able to deploy what's needed going forward unless you fix the foundation upon which banking's built. And what I'm talking about is data and information. Unless you have the ability to collect, compile, and deploy the information across your whole organization, not just to the consumer, but also to decentralize it so that more and more people have access to the tools that the CIO has. Unless you get that fixed or find a partner that can help fix that, you're going to be handcuffed again. You're not going to be able to do everything you need to do. In addition, we need to make sure that data is accessible and that it's actually deployable in a way that makes sense. And I'm not talking about just in the technical sense or from a fraud and risk standpoint, but really from a personalized experience standpoint. And when I'm talking about personalized, I'm not talking about simply having the name and address right or the account number right or the balances right. But how are you letting the consumer know that you know them, that you're looking out for them, that you'll reward them for their relationship on a regular and ongoing basis? It's more than just putting the right name on an envelope or on top of an email or on a mobile device. In fact, the mobile experiences we have found are becoming more and more alike across the industry. So if you're wondering where could you take some money from right now, it may be on I'm going to call it the user experience from a technical standpoint on the mobile device. Because, I'm telling you, if you took the colors away or the logo away, do I really know what the difference in the financial institution is if there's no offers or there's no engagement tools on the device? I get back to resilience. If you do not have your data shop ready to go, if you have not deployed insights across the organization, you're really not going to be ready when the next interest rate hike hits or the next interest rate drop hits. You're not going to be ready when the consumer is ready to buy a car, when they have a new member of the family coming on board, or a baby coming on board. When a person has something happening that you want to know about, you can't do that in the banking industry without data and insights.
That's a great point, and that's a nice transition then to this notion of cognitive banking, which I'll share at its core is around deeply understanding customer situation and customers' needs so that you can better anticipate those solutions that they need and deliver it in a personalized and in a personal interaction. So what does cognitive banking mean to you, Jim, and why is it important for banks?
Well, it's interesting. I know the Personetics has just embraced cognitive banking as a branding recognition, and it's a differentiated experience. I thought it was really keen that your company did this because it goes beyond personalization. It goes beyond the ability to say, if this, then that. The reality is cognitive banking, it's anticipatory. It's taking the logic of what's going on in my life as a consumer and building possible ideas on how you can use what's happening to be better prepared. It's the reality of financial wellness. Financial wellness isn't just making sure that I'm paying my bills on time and taking out credit when I need it, whatever else. Financial wellness is being prepared for the next surprise. Consumers are going to expect their financial institution to prepare them for what they may not have time to prepare for. Cognitive banking means the back office is going to look out for me if there's any fraud or risk. Cognitive banking means you're going to look out for me and say, by the way, you may want to transfer some of these resting funds into a better investment. You may want to take out a loan right now, short-term loan, to take care of something we see coming down the pike that you may know, but you may not have taken action on. As a consumer, I want my financial institution to be a personal partner, to have empathy for my situation, and to offer me solutions not based on the calendar, but based on my calendar. What's going on in my life right now?
Coming back to your point around the data foundation, which is so important, being able to understand customers' needs by cleansing, enriching their transaction data to identify this is the financial situation that they may be confronting right now. One of the things that would really enable what you're talking about is taking that information and propagating it across channels. So not just in the digital channel, but also making your bankers more informed and smarter. Today, bankers may have, they may have lead lists, marketing lead lists, but this is vastly different than that. This is actually taking real customer data and intelligence, being able to deliver it to your bankers and delivering informed interactions from your banker channel, just like you are doing or trying to do through insights in your digital channel.
We realize that you can hit a customer 9 times before they recognize that there's a message being sent, because we scan very quickly. We're all moving faster than we could. But if you reach out to me and you have different ways of communicating to me, then I can select what's the most comfortable. And what's even better is then the financial partner, my financial institution, bank, credit union, can understand, oh, he looks to this channel when he's trying to make this decision. Because I go for different channels for different reasons. I don't buy my healthcare products in the same way I buy my restaurant foods. I don't buy it the same way as I buy things on Amazon or on Uber Eats. It's one of these things that everybody uses channels differently. And that education that's built over time makes it so you can be personal with me. You can be empathetic to me. You can come to me on the channels that I prefer. If you don't take these insights and democratize them across the organization, to the call center, to the branch, to your marketing programs, if you don't democratize this and make it so that you're finding the best way to connect, I may not hear you.
One of the notions that we think is really important to address, Jim, is this aspect of bridging the gap between financial wellness and driving deeper relationships through sales. And when customers feel that you're able to effectively deliver both in a personal way, that is addressing financial wellness and driving deeper relationships through sales, then there's benefits for the customer. There's also great benefits for the bank. So share more about why this is important in terms of being able to connect these principles, why it's important for the bank, why it's important for the customer.
It's interesting. The foundation upon which everything's built in banking is trust. Can I trust you to look out for me? Can it be evident to me that I can trust you to look out for me as opposed to yourself? A Salesforce research that just was released said that consumers trust their financial institution to a pretty high degree. It should be something we should be proud of. On the other hand, when they were asked, do you believe your financial institution is looking out for you rather than themselves? We didn't score nearly as well. And the reality is, it shows. It's been a long time since I was on the dating scene, but it's like when you were dating. Were you truly looking out for the person you were trying to relate to? Or was there an ulterior motive that basically was why the conversation was taking place? Were you talking about you versus talking about the person who you were trying to relate to?
You're bringing up a lot of indelible scars on this topic, by the way, but go ahead, Jim.
But the reality is, it's the same in business. We have found that people on all demographics levels want their financial institution to know them, understand them, and reward them. But there's some that don't. There's some that really harness their privacy a lot more than others. On those people, we have to realize we have to step back. We have to take it a little bit slower. But don't step back for everybody because you had 3 complaints about somebody saying, I wasn't interested in this. Why did you reach out to me? Well, we reached out to you because we're trying to make sure that you're aware of what's available and to do it in an empathetic way. And that means also, Jody, communication across the organization as to how the models are being developed so that the one-to-one person, the branch person, the customer care person realizes that we're not out for it ourselves. We're going to benefit if we look out and are empathetic and are personal with the consumer. But sometimes we'll make mistakes. Amazon doesn't always get it right in what they recommend to me, but I don't hold them accountable for that because they get it right more than wrong. That's how trust is built.
Such a great point that trust transcends, all these advancements in data analytics, AI. It remains the core foundational element.
It also, Jody, opens the door to what's coming up. You start to deploy generative AI solutions. You start to personalize pages of the web page. You start to look at engagement on a human, not digital level on a one-to-one basis, but you start to make it consistent. That only can be done when you have the right data. But every time you do it, it builds that trust factor up that says, you are looking out for me. And if you don't do that right, what will happen is what we're seeing today. Financial institutions are not losing accounts. There's not that much attrition. What they're doing is they're losing and weakening their relationships. And only if we look at flow of funds do we see, oh my gosh, who I thought was a great customer because they've been with me forever and they've been holding the same balances, may have been weakened along the way. They may have 6 other relationships that have been opened that could take away my primary or weaken the power of that primary relationship at all times. And we always use the checking account as a primary financial relationship. Is that still the case? My son, it isn't. It's his credit card relationship. It's his car loan relationship. It's his Venmo relationship. The bank is simply the conduit upon which everything else is built. But the financial institution is not getting any insight from those transactions because my son's going elsewhere to do the transactions.
So important to recognize this point you're making, which is it's the migration of profitability. So profitability migration decline, which is actually much more impactful than the active attrition. Let's dig a little deeper, Jim, into some of the comments you made around personalization. Most banks have invested pretty heavily in personalization technology as part of their MarTech stack. What we've been discussing is this movement from personalization as a capability to having personal interactions with customers. So how do you see the difference between the two, and what do you need to put in place to actually deliver more personal, or as you say, empathetic interactions with customers that show that you're really looking out for them?
Great comment, Jody, because I think that we say great things in the marketplace. We say great things in our investor meetings. We say great things when we're meeting with each other. You see it at conferences all the time. We're building personalized relationships. Are you really? How good is your data stack? How are you communicating with the consumer? How much are you looking at how they're living their lives beyond the financial relationship to determine what their needs are? It's not being done. It's interesting. When we do our annual report on trends and predictions, we keep on seeing that personalization, engagement is very high, number 1 or number 2 every year. And then when we look back and we say, where did you invest your money? Their investments aren't saying the same thing. their prioritization on data analytics falls. It's still high, but it's not nearly as high as it needs to be because they're putting it towards tactile things. They're putting it towards mobile banking. They'll call it digital transformation. But the reality is, when we look at how are you really deploying empathy, how are you really deploying personal interactions, are you really taking it from experiences, user experience, to engagement? How much are you making it so that it's an ongoing discussion with the client, with the customer, with the member, as opposed to simply a push model that pushes the sales of something? And oh, by the way, once you build that relationship, once you build that engagement, once the consumer realizes that they can trust you to look out for them, to know them, and to reward them for their business. We're not talking about points. We're talking about messages at the right time. Once a consumer feels that, you're going to get a better than 50% chance of opening the next relationship with you. Because all of a sudden I realize you're on my side.
Customers can tell what you're saying, Jim, when you're delivering an offer, even if it's a highly modeled offer that, this is based on a customer's browsing behavior and lookalike models and likely to respond versus a similar kind of offer, but that's made within the context of the customer's data and what we know about them. And they can tell the difference between the two.
Oh, yes. Oh, yes.
Right. One is where you're just promoting a product. Second is, as you say, looking out for the customer. I'm delivering you a solution. This is how this solution can help you. And here's the rationale around why I'm proposing it to you.
Well, the challenge also, Jody, is financial institutions know everything they need to know about me. It's how much risk, in the traditional sense, are they willing to take to offer me something knowing that it may be wrong. It may not be timed right. It may not be exact. There's a big difference between perfect and professional. And perfect means if you're waiting until it's perfect, you're never going to make the offer. Professional means you're using great insights and looking out for me, and it's going to get better and better with time. Your company is a great example. You have so many relationships across the financial services marketplace that you keep on testing what's working, what's not, what's a good hit, what's a bad. Where did we maybe go too far? And you get that out of the loop right then, unless the leader says, I want to go for that, because the wins are going to be much greater than the little bit of uncomfortableness I may find. Financial institutions have to understand that some of this is going to take some risk. Your best clients continuously step out there and say, how can we bring a better relationship, more empathy, more personalization on a personal level to the engagement, where we can use what's going on outside their financial relationship more than just inside, or more than just calendar history. Buying a car in the fall, buying a house in the spring. What can we do better?
Let me ask for your perspective also on multi-channel behavior. Traditional banks they've earned and retained business a great deal based on the banker relationship. How do you see this evolving in the digital age, in the data and analytics advancements, and how should banks adapt?
It's interesting because it's not about just hitting them in more places. It's hitting the consumer in the places that they want to see you. I sometimes see in the middle of as I'm doing a search, all of a sudden I'm seeing an ad for something that I know followed me from the financial brand, let's say, and it follows me in a traditional digital way. But the reality is, how can I make that digital experience more personal? How can I bring it back to a human? And when you think about it, that's what cognitive banking is all about. That's what cognitive relationships are all about. Can I react on a dime to a situation that happens and try to get, and we've talked about it for decades, try to get a surprise and delight. The way you're going to get a surprise and delight from me as a bank is when I come out on behalf of the consumer, on behalf of the customer or member, and partner with them on their financial journey at the point of key interaction. I'll keep on going to my Google Maps, my GPS system on my car. If you're telling me get off at this exit and get back on the freeway again because there's an accident right on the bridge between the exit and the entrance, you've saved me possibly hours and you've been my friend in a very digital way. The consumer's becoming more aware than ever on what's possible. We've got to start to deliver on what's possible. People are wildly aware of what generative AI can do. Where are we going to be when they want our generative AI solutions?
I'd like to get your perspective on another broad topic, which is around product strategy. The traditional product structure has been in place for quite a while, and many banks align their business units around it, deposits, cards, and loans. And what we're seeing is an evolution in the thinking of our customers are not just looking for a checking product or a mortgage. They are in the process of preparing to buy a home 18 months from now, or they want to start setting aside some emergency savings or saving for some kind of an outcome, or they've just changed their job and they want to get set up on the right track to be able to now accommodate this new inflows that they're going to have. These are more what we call jobs to be done and require a bank to think not just about what product do I have, but what kind of combination of products, tools, insights, tracking, acknowledgement, and rewards, and nudges can help me deliver on this. Let's call this micro journey, and it's different construct than simply product. So I'd be interested in your perspective, how you're seeing this evolution happening in banks and this movement towards understanding what's the need that the customer has over time, and then how can I compose the right set of interactions, products, content, tools, insights to be able to help them achieve that job.
It's very interesting because there are very few organizations that I see breaking down the walls of traditional products. We're a conservative industry. We're an industry that really lives to the fact that we've been very successful with the products, the checking account, the savings account, the loan product, the car loan, the mortgage loan, the long-term CD. But as you mentioned, what I really want is a nuanced account that maybe brings it all together, maybe becomes that relationship that includes maybe like my mom's envelopes back when I was a child that set aside money for a vacation, money for a car, money for school, and put it in either real envelopes and kept in the house or build accounts around that. We should be able to help a consumer in a very quick and easy way open up relationships that relate to what their goals are. You brought up really well. My son just got married last year. They got money at the wedding. Nobody said, oh, by the way, we see you've been spending a lot of things that most married couples are about to spend on. We know you took a trip. What can we do to help you set up savings for what's in your future? Do you want a savings account for when you have a child? Are you interested in a savings account for a new house? Do you want these type of things? And do you want us to help you with the transfer of funds so you don't have to manually do it all the time? Can we assist you in this? And what's interesting is, as financial institutions, we really lack in asking questions. We do surveys. We don't ask questions that build the relationship. And now more than ever, this is what digital banking is all about. I remember sitting down with my first financial planner when I had no money. But they asked, 9 pages of questions. They took all the manual data and they put in that file cabinet right to the side of their desk, never to be opened again, because I wasn't that big of a prospect. Well, now in a digital world where all these questions can be asked, or a few at a time can be asked, where I can put it digitally and I can have these accessible by firms like Personetics, where you can actually use this as a way to build a conversation on how can I build banking better for you. I made it very clear that I wanted to build a savings account using withdrawals for all different, both markups and automatic withdrawals every month, almost like a 401k past my 401k days. And then I went to my financial planner. I said, I want to have my investments protected against losses, even if it means limiting the gains. So they get me into new products and they have the transfer of funds automatically happening. That's financial wellness, where it's not in a construct that's all these silos, which banks just love. They hate them, but they don't change them. But how do you make it so that those relationships become more of an overall account structure that doesn't have the walls, that flows between room to room to room based on what the need is, but it's automatic? I mean, PNC years ago built an account that was all these accounts built into one. They thought it was a great Gen X, I guess was back then, Gen S account. And it was. But they didn't realize that every consumer wanted something that didn't have the barriers. That when I had an overdraft, you wouldn't hit me with an overdraft notice, you'd take it out of my savings plan. Or you'd ask me, can we access it from another account? And when you're talking about speed of funds, when you're talking about instant payments, that's a good thing and a bad thing. Instant payments is great unless you're making them. And then you realize, geez, this became accessible. Like, I don't have that 4-day lag that I used to have. Well, will my bank protect me against things that I do wrong? That's empathy. It's not just about the product you open. It's how you manage my relationship. Oh, and by the way, outside of the bank I'm currently using. Are you going to protect me by pulling funds or asking to pull funds from an account I also have that's not with the same financial institution?
Yeah, just think about how much more powerful all this not just can be, but frankly needs to be able to compete well when the North American market really embraces open banking in a bigger way. And now you've got bank data, you've got external data, and delivering insights, intelligence, helping customers anticipate needs across both on us relationships, but also relationships that may be off us in other banks. And if you can do that well, then you really stand to gain from this movement towards open banking.
Like Mint 7.0. I mean, it's like the old Mint relationship that you were able to put all these things in one place. And consumers, I think, are more willing to do that with the financial institutions they trust. And that's just a stepping stone towards agentic AI and what can be done from a digital platform to work on your behalf or my behalf.
Yeah, exciting. Lastly, Jim, what do you think customers will expect from the banking industry in the next 3 to 5 years for which the industry is not well prepared?
I think what consumers are going to expect is the continued expansion on how AI can help financial institutions build these cognitive banking relationships, these cognitive banking interactions, these personal solution sets that make me better as a financial customer and as a person trying to manage my finances. The one thing I don't have more of is time. So you need to make that better. So I think while it probably won't happen in the near term, we as financial institutions have to be prepared for what I'm going to call the agentic AI banking time, where I'm going to either build my relationship with an outside company that's going to say, I'll be your digital agent to work with your finances, or my bank will do that. I'd rather have my financial institution who I've already built a relationship with, who I have a little bit of leverage with, do that for me. I need my financial institution to step out from behind the curtain on knowing me, but not tell me you know me, to showing me you know me every day. I don't mean interacting with me every day, but I believe that consumers can be pushed because everything around us is changing so quickly. We know we're tracked on social media. We know we're tracked in everything we do, even the way we buy groceries. As we walk through the grocery store, the Trader Joe's or the Whole Foods, we know we're being tracked. We know that as we select things, they know what we're selecting. Why can't we do that in banking? Why can't my financial institution look at my Amazon purchases, my other purchases they may not have access to right now? Why don't you ask me Can I take all this and make it happen? Because if you don't, it's going to be very much like open banking's happened in the U.S. From my perspective, open banking is alive and well in the U.S., being managed by the consumer. I have 7 different primary financial relationships, and I'm managing them right now. It's my open banking solution. It's my SoFi. It's my Acorns. It's my Wells Fargo. It's my PNC. It's my car loan, my Ally Bank car loan. These all could be combined into one relationship if anybody would help me with my banking. I don't like doing banking. I have to do banking. We've got to change that. So in the next 3 years to 5 years, I see certain organizations stepping out from behind the curtain and showing what they can do. You already have clients that are doing that. We already see that. We have other partners that we work with that are doing the same thing, that are actually making it so I can open a new account in 3 minutes as opposed to 20 minutes, who make it easy for doing it on a mobile device. But we still have financial institutions that, as I'm using my credit card to buy airplane tickets, they don't take notice and go, can we help you with this trip? Can we set up things outside of banking maybe? Be my partner. You know more about me than anybody else in the world. Show it. Be personal. Be cognitive.
And to end on that note, 2 things that I think we'll see with this concept of cognitive banking, which are very related. One is greater intelligence, customer intelligence, being sent across the enterprise, propagated across the enterprise. So you're into your MarTech stack. So marketing interactions will become more personal, but your banker will also be much more informed in terms of how they engage. That's one area. And the second is in the digital channel, which our traditional notion has been, okay, let's offer insights. Let's offer something that is can help anticipate. The challenge with the digital channel is it lacks some degree of empathy from the human channel. And this is where we will see more empathy, a more human element in the digital channel as well. So in some ways, you're making the branch and marketing channels more digital, more intelligent, and you're also bringing more of a human aspect into the digital channel. So it's actually an exciting, what seems like a paradox, but I think all of that is again grounded in this idea about customer intelligence and delivering more empathetic interactions that feel more personal.
It's going to take risk, and it's not a bad risk. We've got to take a step out from the ordinary, we got to dip our toe in the water, but we got to get in chest deep in the water now. It's going faster, and the challenge is that train is going down the track. And the longer you let it go down the track without you embracing what's possible, the further behind you're going to be. And oh, by the way, catching up isn't going to be possible. You've got to do this now. You've got to take action today to build that personal relationship with your customers and with your members.
A great note to end on. Jim, you've dispensed more advice than a barista dispenses coffee. Once again, thank you.
Bring it all home.
Thank you for not just for the podcast, but also for your role in the industry and your commitment to really advancing the capabilities of the entire industry.
Thank you, Jody. I appreciate talking to you outside of a conference. I think it's the most sit-down talking time we've had in years, so that's a treat.
Mine as well. Thank you, Jim. Thank you for joining another episode of Banking on Innovation. Make sure you subscribe to get future podcast episodes. Please follow us on LinkedIn and at Personetics.com.